The third scenario, and this is the hardest scenario to see, but it's the most rewarding if you see it, is that the market continues lower and the open interest goes up. When that happens, and it does happen at turning points, for a day or two, the open interest will go up as the market's continuing to go down. And that's because the big hedge funds are buying it as the small hedge funds are getting short.
Welcome to the Morning Markets and Metals with Vince Lanci, where each day he brings you the precious metals and financial news to get you ready for your day. And now, here's Vince.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And just a quick note, as this week, our beloved Vince Lanci is finally taking a well-earned and deserved vacation, and he is going to be off this week, although fortunately the natural-born teacher that he is, he left behind some great things that have been ongoing in the markets. And with that said, let's get back into today's show.
All right. We're going to talk about gold's possible path from here forward. This conversation is like having a conversation about risk and trying to handicap future behavior of players. We tend to not pick price. That's what a technician does. We tend to pick behavior. So if I know what the behavior is, I can pretty much tell you the direction of the price. The magnitude of the price, I cannot tell you. That's what a technician does. My job is to say, arrow point up, arrow point down, and then we look for something to tell us behaviorally that the market is not going to continue in a certain direction. And those signals can also be technical as well. But anyway, our focus today is something that's near and dear to my heart. It's derivative of the Commitment of Traders report. Now, just as a quick background, first of all, what you're looking at there is the gold line or the yellow line. That's the price of gold. Here's a clean chart going back to, I don't know, it looks like July or June of 23. Right? And this is Randall Blava. He's a founder, and he contributes this on the weekend. Incidentally, to the other founders, I'm giving out homework assignments now. We're all going to be doing this. We're going to run it like a meeting of traders. It won't just be me flapping my gums all the time. All right, so back to this. So the gold line is the gold price, right? And on the bottom, you have the red line, that's the change in open interest, or that's the aggregate open interest, not the change. And the blue line will be a moving average based on that. We're not that concerned with the moving average for this. You may want to use it for a confirmation in your own trading, but you'd have to have access to it on a daily basis. What we're interested in is the direction of the moving average and the reversal points of moving averages as they relate to the gold market. Now, what I'm about to tell you applies in every market, but the specifics I'm giving you are about gold itself. Open interest moves reveal who the player is acting in a market. Sometimes it's very precise. Sometimes it's not very precise. But open interest in the gold market is very easy for me to see. Now, I can see it in other markets just as well. But the bottom line is the gold market has been forever incredibly predictable. And that's because there's only really two players. The one player is the swap dealer, the bullion bank, whose behavior is dominated by their client book, and their client book is almost always selling, was almost always selling. And because of that, they're naturally biased bearish. Now, we're not going to get into the whole manipulation part here. Okay, we're talking about clean markets. Manipulation happens, but that's not what this conversation is about. Now, the counterparty to the bullion bank and their customers, right, is the speculative fund or the hedge fund or the investor. And the investor is historically, naturally a buyer. So the bullion bank is a seller. The hedge fund is a buyer, and they meet up in the market. So the hedge fund says, I'm bullish, and he buys it. And the bank trader says, I'm bearish, and he sells it. Now, the difference between the two is this: regardless of what you feel about how bullion banks operate ethically or not, I'm telling you that bullion banks, if they don't have customer order flow to sell, they're not bearish. So assume that they're always bearish because they always net have customers to sell. And they're always either trading on that basis or literally executing orders for the customer. Look, if you have a customer who's got 1,000 contracts to sell, $5 higher, you're not going to speculate long. And these guys do speculate. You're going to either speculate flat or short. because you know that they're selling above. You know what's on the order book. You see the depth of market much more than other people do. But they've lost that control over the last couple of years. They still have it, but it's waning in influence. Now, when you look at the gold players in the market, in this case, the buyers are the hedge funds. Not all hedge funds are buyers, but I'm going to speak in generalities here. And then you have the bullion banks that are sellers. They meet up. So who determines what direction the market goes in? The funds determine direction. What does that mean? That means the funds initiate. They say, I'm bullish today. They get out of bed. They say, I'm bullish, and they buy it. And when they buy it, they're placing their bet. And when they buy it, who do they buy it from? Well, almost always they buy it from the bullion bank, and the bullion bank sells it to them, right? So the buyer buys from the seller. The buyer pushes the market in the direction they want it to go because they're impulsive, because they want it to go up, because they're not patient. And that's how hedge funds operate. The bullion bank is like a bookie or a dealer. And the bullion bank says, I'll sell it to you. But the bullion bank decides what price they want to sell it to you at. So if let's just pretend at a very simple level, I'm a hedge fund trader, right? I'm a person. And I go, I'm bullish. I think it's going to go up. Where do I think it's going to go? I think it's going to go to 2,500. Okay. Then I'm going to buy it at 22.85. Oh, it's 22.86. Then I'll buy it at 22.86. Oh, it's 20. I'll just keep buying it. Right? Until it gets to 2,500, more or less. I'm simplifying it. Now, translated, that means the direction is determined by the fund. Now, how does that work the other way? Well, the fund has already bought. I'm the fund. I bought it. I bought it at 22.80. The market's trading 23.50. And then I turn around and say, oh, non-farm payrolls are bearish. I'm going to sell my longs out. Which way does the market go? It goes in the direction of my trade. The market will run away from the hedge fund, right? That's why it's like it's a rug pull, because they all tend to move like a herd, right? So the direction, the arrow of the market is determined by the funds going into the market. Now you may say, well, that's not really that important. And I would say, you're right. What's important is how far the arrow goes in that direction. You know who determines that? The bullion bank. So for example, if the hedge fund has 1,000 contracts to buy and the bullion bank has 1,000 contracts to sell, then the market's going to move $1 higher. And that's it, because the bank wants to sell it. If the bank doesn't have 1,000 contracts to sell, $1 higher, but they have 1,000 contracts to sell $20 higher, well, the bank is going to let the market run higher until it runs into their natural selling. So the funds determine direction. I'm bullish. I'm going to buy it, like a kid at a candy counter, right? And the guy behind the counter is the bullion bank saying, well, how much will you pay for that candy, kid? And that's how it works. The banks are bookies. When you call up a bookie and you say, I'm going to bet on Dallas, he immediately moves the line to make Dallas more expensive. And that's how the game works. And it works in both directions like that. Now, it's not 100% like that, but it's more than 80% like that. Now, it is changing, but I'm giving you the secret. The funds determine direction, and the banks determine magnitude of direction. Now, if you want to be a little cynical about it, well, if the funds buy 1,000 contracts and the banks sell 1,000 contracts $1 higher, well, that's crazy. That means the funds couldn't budge the market much at all. And you should be scared to death, because that probably means that the banks have more to sell. And then you could say to yourself, oh no, they're going to push it lower. That's right. And they will push it lower after they see how many you have to buy. How much money are you placing on the Cowboys, Vince? $50. Oh, no problem. And then I'm just going to stuff it up your butt, right? If I have $1 billion to bet on the Cowboys, well, then they're going to go take a phone call, right? Then they're going to back off. Then they're going to be savvy about it. They're going to call up another bookie and lay off some of their bets. That's how these guys operate. That's how I operated as a market maker in options. But I didn't have orders. I literally manage risk. I don't have a lot of respect for bullion bank traders. And I hope they all get destroyed, but they won't. But a couple of them will. and I can't wait for it. Because as an old man said to me once, bullion bank traders don't make money. The chair that they sit in makes the money. It's the customer base that determines if they make money or not. If they don't have any customers, they can't survive. It's like, they live off of someone else's coattails. Anyway, personal animosity aside, everyone's got a role to play. All right, so that's the background. So what can we, from that history, is my little pointer there. We're going to prove that I'm right. Now, I want you to pretend there's only two players in the market. A hedge fund who always buys initially when he's bullish and then sells when he wants to get out. And a bank who always sells initially and then buys when the fund wants to get out. So the hedge fund buys, open interest goes up, market goes up. The hedge fund sells to the bank, open interest goes down, market goes down. The hedge fund buys, open interest goes up, market goes up. The hedge fund sells, market goes down, the open interest goes down. See how that works, right? This is the hedge fund buying from the bank. This is the hedge fund selling back to the bank. The open interest closes, okay? This section here that I just showed you is normal behavior. Market goes up, open interest goes up. Market goes down, open interest goes down. Market goes up, open interest goes up. Market goes down, open interest goes down. See that? This area here is where something changed. Now, I know what changed. We'll talk about that in a second. And this area here is where something else changed. And this area here is where this change continued. And this area here, I'll get into the details on this, are what I hope is going to happen next. All right. Same chart, bigger, but with some words. Now, I'll tell you some stories. This may not be 100% true, but I'm pretty sure it is. In December 3rd, when the market rallied overnight, December 4th, if you're on Monday time, the market spiked higher. Now, I had gotten word from some players that a sovereign wealth fund was in the market, wanted to buy, and they drove the market really hard against them. Again, impulsive. Sovereign wealth funds are not central banks. They're usually not as tactically smart as central banks are. And so they came in and they kind of were like a bull in a china shop, and there were already shorts in the market, and there were Shanghai buyers, and the market spiked. This was a big spike, forget about this. This was a big spike. And I was told the Bank of International Settlements came in and sat on it. And for those of you who think the Bank of International Settlements is ever bullish, they're never bullish. And that's because they're always buying. So they'll sell it to buy it, okay? If they're not selling it to buy it, they're selling it for someone else to buy it. So the Bank of International Settlements came in like a bookie. So I want you to think of it this way. The bullion banks are the bookies in the market, and the Bank of International Settlements is the bookie's bookie. Market gets out of hand, the Bank of International Settlement comes in and stops it. They are kind of like putting a lid on a market, like there's an expression, limit up, when a market goes limit up or when the market stops trading, like you see a lot of meme stocks do. The Bank of International Settlements is providing that kind of a role. Okay, so that's the Bank of International Settlements. They sold here. I can't prove this, mind you, but I'm right. They sold here and they sold here. Now, as I described in the previous chart, the market goes up, the open interest goes up in broad strokes. The market goes down, open interest goes down. Now, the market goes up, open interest goes up. The market goes down, open interest goes down. So far, between here and here, the market's behaving normally. Then the market goes down, open interest goes down. The market goes sideways, open interest goes down. The market goes up a little bit, open interest goes down. The market goes down a little bit, open interest goes down. The market goes up a little bit, open interest goes down. See this? This section here? From January 1st to February 28th. Notice how it lines up very nicely with the market. The open interest goes down for 2 months. The market goes sideways for 2 months. This is very important. I'm going to share with you why. First of all, buy the book before I tell you the story. This is those speculative hedge funds that I told you, selling, getting out. And when they sell, the market's supposed to go down. It's supposed to go down a lot. I mean, even more than this. I mean, look at this move. If I go back further, see how the market was all the way down here and the open interest was down here. Now the open interest is down here and the market is all the way up here. Open interest was down here, market was there. Open interest gets back to down here, market is here. So for this period, all of the speculators sold because the open interest in futures went down, but the market didn't go anywhere. Why is that? That's because at this part, the market started being dominated by physical players. Now, it had been dominated by physical players before, but this is where it became obvious. See, every time the market was sold in futures, it was bought by the bank, but the bank also was selling it in the private cash over-the-counter market to a central bank or sovereign wealth fund who wanted to buy it to take delivery. So the market goes sideways while everyone in the world who doesn't know what's going on is selling it. The open interest is dropping and the market is not dropping because you've got central banks saying, I'll buy it. I'll take on all comers. They're putting in a floor for this market. Now, I don't care who's doing it, whether I'm right or wrong about the story. This is a fact. There's a technical analysis fact. The market stays here while the open interest goes to zero. This is the gun loaded and firing. This is the gun reloaded and ready to fire. And sure enough, as it upticks, the central banks stop buying. Maybe they're still buying, but the central banks aren't chasing the market. They're just saying, I'm going to buy it here. Let me know when it gets there and I'll buy it there. But then in this area, the funds who bought it over here, or someone representing those funds, they decide they want in again in a vicious way. And the market goes whoosh all the way up to here. Now we'll just start here, right? This is interesting. It's also another example of this. So the market goes to here and the open interest goes all the way up. Let's call it to here. Goes all the way up to here. And the market goes to here. Okay. So what do you have here? You have those funds that I told you to buy, but I happen to know that these funds are even bigger than these funds. Bigger means more money. Bigger means more staying power. Bigger means more patience. Bigger means able to go head to head with the bullion banks and not give a shit day to day. They have more staying power at the poker table. And then the market goes sideways and the open interest comes off. This right here is a mini version of this. See this? See this here? Market goes sideways, open interest comes off. Market goes sideways, open interest comes off. And then the market goes up again and the open interest goes up again. Not incredibly steep, but it goes up. Then the BIS comes in again and they sell because it's getting out of hand. And the market gets capped and it comes down. Now the open interest starts going up. This is a little bit of a mystery to me. Don't get me wrong. If I don't know, I'm not going to tell you. I'm not going to make some bullshit up. I'm just not going to trade it, right? You only trade what you know. But then market is capped again by the BIS. And this time market goes lower and the open interest doesn't stabilize. The open interest starts to come off. And I say, this is what we're looking for. We're looking for a repeat of this behavior. We want the open interest to come off while the market comes off or goes sideways. And lo and behold, the market starts to come off and the open interest comes off. But the market, again, doesn't come off as much as you'd think, given this steep of a decline in the open interest. So from January 1st, to give you an idea, to February 28th, the market gave back. See these two lines here? I'll help you out here. Randall and I drew these. Well, actually, Randall drew them, but I had something to say about it. See these two lines here? These are pretty much covering most of the range. Usually open interest bottoms here and tops there, bottoms here and tops there. This is all new area. This is all new behavior for us. Even this is new behavior, right? So generally speaking, most of the market's activity takes place in between these two lines. So when it went down here, that was an aberration, but the market never went down. That was very good. So now here we are over here. The market gets back into this line, back into its normal behavior. And remember, from January 1st to February 28th, it came in this much, right? So let's call it 100% of this area. And now between, call it May, I don't know, 15th to June 11th. In 1 month, it's done 80% of what it did in 2 months. And that means these guys got out in a hurry. That means the funds, those speculators, they were like, I want to get out. I want to take profits. I think it's going down. The non-farm payroll is coming up. Whatever the reason, the funds determined direction by selling. And the banks determined magnitude of direction by buying it from them. And did the banks let it drop much? No, they didn't, except for this one day. No, they didn't. Now, why are the banks not letting it drop much? Because like here, when open interest came off and the market didn't move, they have buying again. All right. So far, I'm right. So for this to continue, you want to see the open interest continue to go down and this market continue to stabilize in this area. Now, can it go down to here? Yeah. Can it go down to here? Yeah. Can it go down to here? Yeah. And it's still higher than here. You follow? It's like in a very simplistic way, the market is up here with the open interest back to here again. This is how much the market has moved in one investing cycle. Guys, that's phenomenal. It's incredibly healthy. So if things were to continue according to the perfect plan, and it's never perfect, you'll see this market chop around in here and this make a new low. And then at some point, there'll be a trigger. Maybe you'll see it in an RSI or a MACD or a stochastic cross or a non-confirmation on some indicator that you look at, and the market will make a low in open interest and not a low in the market, or the market will make a low and come off the low and start to move higher. And this will start to move up again. And once it starts to move up again, boom. Okay. So this could be a repeat of this. And if this is a repeat of this, when this turns up again, the market has another leg higher. 26, 25, 26, 27, 28, who knows? But that's what I'm saying. Now, other scenarios, yeah, these other scenarios are out there. Now, the scenarios are this market cracks and it gets all the way down to here, let's say, right? That's the GLD price. And it gets all the way down to here and the open interest continues to go down and you say, all right, well, even more guys are selling. You just use your indicator. You don't buy it until you get some indicator that says we're bottoming. But, it's on your radar now. That's a second scenario. The third scenario, and this is the hardest scenario to see, but it's the most rewarding if you see it, is that the market continues lower and the open interest goes up. When that happens, and it does happen at turning points, for a day or two, the open interest will go up as the market's continuing to go down. And that's because the big hedge funds are buying it as the small hedge funds are getting short. We call that selling it in the hole or puking on the lows or being a contra. It's a Kramer trade. Kramer is selling it down here, getting short, and the Paul Tudor Joneses of the world are buying it. And when that happens, it's really hard to identify. But if you identify it, you know to strap your guns on and wait. And if the open interest goes up the next day and the market goes up the next day, you pull your guns out of your holster and you just get long. You put a stop in, but you get long. So the third scenario is the hardest to see, the trickiest to understand, but the most rewarding if you catch it. And it's very rare. And that is the market open interest starts to go up while the market continues down. And the market will continue to go down and the open interest will go up. And then one day the market will just turn and the open interest will keep going up. And then you know there's trouble, right? That's pretty much the whole thing. And let me pull up another chart with some more words. Now, by the way, macro discretionaries who bought here, that wasn't your regular CTA guys. Here's the next chart. All right, so I'm going to explain this chart now. All right, first sentence, patient physical buyers determine price action. That's what I said to you, right? Well, actually, I didn't say that. What I said was hedge funds determine price action. But in this area here, in the biggest picture, not the day-to-day picture I look at, on the investment side, patient physical buyers determine price action, meaning they stop it from going down. impatient fund sellers determine open interest. So if the open interest is dropping, that's the funds selling to the banks. But if the market's not dropping, that's because the banks don't have room to let it drop because they have the buy order. See? So this is kind of a weird thing to say, but it's accurate. So now look at this in aggregate. BIS slams it, it goes sideways, someone buys it. The BIS slams it, it goes sideways, someone buys it. The BIS slams it, it goes sideways. Is someone buying it? I don't know. I think there's another buyer here. I wrote another physical buyer. It's really a question, but I think so. I frankly, I think it's incredible for a physical buyer to be stepping up their bid at this site. I thought they would be back down here again. So if this market doesn't go to here, I thought the market would go here. This is where the last physical buyer was. I thought the market would go to here, frankly. I didn't share that, but I wasn't buying the first dip, okay? I thought the market's going to get to here, and then the physical buyer will step in. Well, he hasn't had to buy down here yet. Someone is buying here. How much? I don't know. But if we're here a month from now and the open interest is down here, man, you do not want to be short gold a month from now. Once upon a time, sideways was always bearish in gold because the longs lose patience, because the longs are funds and they borrow money and they have to have a return on that money. If they don't, their investors take the money back. But central banks don't borrow money. They create money. They can be as patient as the day is long. So they're not selling, they're taking delivery. So the home run would be the market goes sideways for a month, like here, and the open interest goes down even lower to here. This is the gun being loaded. This is the springboard. This is the trampoline being depressed, okay, before the market springs, right? So I would give that a 30% chance of being true. I'd love to give it a higher chance, but I will not. You just don't do that because you end up getting crazy. Then another 30% chance of being true is I think the market will drop more. Actually, I'm going to give it a bigger chance. I will give the market a 60% chance that it's going to drop to here. And the open interest is going to stay low. Why? Because that's how I protect myself from being too bullish tactically. And then the last 10 to 20% will have one of those little fishhook turns here and the market keeps going lower. That's like 10 or 20%. So in in the first instance, the market goes sideways and then higher. In the second instance, the market drops significantly and then goes higher. And the third instance, the market drops significantly, the open interest turns up, then it goes higher, even harder, even faster. And that's what I wanted to show you all. That's what I'm looking for. And my analysis will be based on that. Now, just to give you an idea of my position, I'm long miners and I'm short gold call spreads. Now, I missed the last $200 in gold. Let's be fair. I did. I was getting out here. I was like, oh, this is crazy. This is crazy. This is crazy. And when it came down after, I said, oh, we're going to go down again. Oh, we didn't go down. I'm like, you know what? This is this. I'm not playing games here. Now, there's another factor that makes me less bullish. There is a seasonality in gold, and I've talked about that before. And we're not there yet, but we're entering into sell season. Now, look, seasonality doesn't matter if this is going on in the big picture, but seasonality matters in the short term. So we may not go down in October, but there sure shit should be some selling to prevent us from going up too hard. So the market might be well balanced and absorb a lot of selling in October. And that October selling could be absorbed at this level. So I would love to see this market go sideways and then higher, or drop precipitously and fast and go higher. And if it works its way down gradually, well, that's not going to make me bearish, but it's going to make me hard to tactically do my thing. All right. Hope this was helpful for you, and I'll see you at the show.
Well, thanks for tuning into today's Markets and Metals with Vince Lanci. The show is brought to you each day by Miles Franklin Precious Metals, who we encourage you to consider for your next gold or silver purchase or sale. Miles Franklin has pricing that's among the best in the industry on most products, and Arcadia is proud to be a licensed Miles Franklin representative and happy to help whenever you have questions or want to place an order. Where this week's silver special is 1 ounce silver Britannias for only $3.15 over spot. Silver Britannia is the sovereign coin from the Royal Mint in England and has the added advantage of being IRA eligible. Place an order, get more information, or speak with me directly. Call us at 833-326-4653, and we'll be happy to help you get whatever you need. So thanks for watching, and we look forward to hearing from you.
Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.